Hello everyone, very good evening to all. Welcome you all in the YouTube channel of Oliveboard. Please confirm my audibility and visibility so that we can start our session. Please confirm my Okay, I guess everything is perfect. Fine. Okay, everything is good. Everything is fine. Now, we are on the 23rd unit of Module C of paper ABM, that is the credit management. The module we are covering is credit management, and the name of the unit is risk management and credit rating. So we have done many chapters related to credit management. Here overview of credit management we have seen, then credit control, STP. All these chapters we have already covered. So I hope you have watched all those sessions. You have already watched them, and if you have not done so far, then please do watch the sessions. So today we have to start unit one number 23, that is risk management and credit rating. See, we know that in an organization we have to manage everything. We have to manage all the functions of the organization. We have to manage all the departments. We have to manage the people. We have to manage the borrowers. Okay, we have to manage the lending authorities also. So definitely risk also comes. Okay, if a person is lending the money to the borrower, then definitely risk will also come. He will have a fear in the mind that whether the money the person, the borrower, has taken will refund back or not, will repay back or not. So risk arises everywhere. There is a need of proper management of risk to identify the risk, so that once a risk has been identified, we will take important steps to minimize all those activities. Here, what is risk management? Now, what is credit rating? We have seen risk management to manage the risk from the borrowers and lenders perspective. Now, what is credit rating? So it is an assessment of person's ability to repay debt. It basically tells that the borrower's credit worthiness. Suppose this person has taken a loan from this particular bank. Let's take an example, ABC Bank. Now, this bank has given the loan to this person, and when the repayment date comes, this person fails to repay the loan. Now, what happens in this case? In this case, the bank will not going to get his money back, the failure of repayment. So it basically tells that credit rating tells that the credit worthiness of the borrower. The borrower's credit worthiness will tell that, okay, this borrower is good. This borrower takes the money, borrows the money, and this borrower refunds the money, repay the money back. That is the good credit worthiness. If not, that is the bad credit worthiness. So credit rating is what? Credit rating is good. If credit rating is good, it means that risk is less, and vice versa. If credit rating is bad, it means that there are more chances of risk. The risk is what? It is comparatively very high. Credit rating is an evaluation of the credit risk of a debt. This is what we have to study in particular unit. Now, what is credit risk? So credit risk basically is whatever money you have lended, the money you will get back or not. That is, money will get back or not. That is what credit risk. In this case, borrower has taken the money, and this ABC Limited Bank, the bank will have a fear in his mind that whether I'll be getting my money back or not. This such kind of risk is known as credit risk. There is risk that might this person not going to return the money back. The risk faced by business or banking can be classified into three broad categories. So risk can be classified into three different categories. The first category is operational risk. The second category is market risk. And the third category is what? It is credit risk. So operational risk. This basically tells that the day-to-day operations of a business. Okay. Related to bank's day-to-day operation, day-to-day activity. Related to bank's day-to-day activity. If there are high risk in the operations of the bank, then definitely there are less chances of growth. So examples of operational risk will include the scams, the frauds. Such risk are losses due to frauds, disruption of business due to natural calamities like flood. Like the biggest impact was the COVID-19. This basically tells the risk of failure. Risk comes from the failure of person or failure of process or both. This line is very important. Operational risk consists, this risk include the failure of people or process or both. Either people, either any kind of process or both. Now, market risk is what? This risk basically comes from the market conditions. This emerges from market conditions, that is, market fluctuation like inflation, deflation, interest rate, exchange rate, okay, currency rate. Sometimes it is high, sometimes it is low, means it is not a stable, it is dynamic. We know that market is dynamic, it keeps on changing every time. So we also have to be ready for what are the changes that are taking place in the environment, that are taking place in the external factors. We need to adapt to that and we should be ready for that as well. So these are the risks resulting from adverse market movements like interest rate, exchange rate, inflation, deflation, recession, inflation targeting. They are the risk emanating from with adverse and undesirable but uncontrollable play of market forces. So see, we cannot control the market. Market is what? It comes under the external factors. And there are two factors. One is internal and one is external. Internal means what? The controllable factors, which we can control them. And what are external factors? Those factors which we cannot control them. Those are uncontrollable factors. Now, credit risk again, the credit risk is the non-payment of principal and interest by the borrower as agreed by the terms. This comes under credit risk. Okay, so for this credit risk, the credit rating is being done. This rating tells that whether the borrower's credit worthiness. Operational risk, it comes from the failure of person, failure of process, any system is not working. Okay, any kind of things which are in internal factors that are not working, the people, the HR, they are not working properly. So it arises from such categories. Operational risk. Market risk, it arises from the market forces, that is demand and supply. We cannot control demand, we cannot control supply, we cannot control inflation. So all these are what? Adverse market conditions that help to arise what? Market risk. Now, credit risk, this is the failure of the borrower. When the borrower has done any kind of default, the credit risk arises. Now, what are the factors that affect credit risk? There are two factors, external and internal. External factors, the same. These are the uncontrollable factors. We cannot control them, whereas internal factors are the controllable factors. We can control them. Like bus- these factors affect the business of a customer and reduce the capability. Okay, government policies, policies of countries, political risk, interest rate fluctuations. These are what external factors. We have seen one word that is pestle. Political, economic, social, technological, legal, and environmental. So these are the factors that causes what external factors. Now, internal factors, these are controllable. You can control your internal things. You can control your internal bag. You can control your people who are working in your bag. So the mainly relate to overexposure of a credit to a particular segment. So this talks about the specific, like ignoring purpose of loan, faulty loan, repayment structuring, borrower's defaulter, deficiencies in loan, loan appraisal is not done, loan disbursement is not done properly, low quality credit appraisal, lack of recovery, efficient recovery machinery. So all these are the internal factors that is, if needed, we can control them, we can improve them, we can overcome them. But these factors are not controllable. Now, what are the steps taken to mitigate credit risk? Mitigate means what? To minimize credit risk. Definitely, if there are risks, risk identification is done. Now, second steps is what? To see different to find out different ways how we can mitigate the credit risk, how we can minimize the credit risk. So at two levels, we can do this at macro level and micro level. Macro means as a whole, economy as a whole. When we take the whole economy together, when we take the whole society, when we take the whole bank, when we take the whole environment, that is macro level. And when we talk about any specific category, when we talk about any particular thing, that includes micro level, means of one individual, of one market, whereas macro consists of market as a whole, individual as a whole. Yes, tell me. Like the risk to the overall credit portfolio of a bank are mitigated through frequent reviews of norms, fixing internal limits, aggregating commitments to specific sectors. So these are the things which you have to take into consideration as a whole. Like policies. If the policy is being changed, it is changed for every bank, not only for only PNB, for Union Bank of India. No, if new policies are framed, new policies are formulated, it is being formulated for every bank. Every bank has to follow the same policies. Rectification done on the basis of, if rectification is done, if any kind of corrections are made, if any kind of reforms are made, so every bank has to follow that. Restructuring, recovery, write off. Okay, all these comes under where macro level. Whereas in micro level, like for example, if you want to check the risk of any particular bank, if you want to check the documents of any particular bank, if you want to do the audit of any particular bank, you want to do that, you want to check out that, monitoring the activities of any specific bank, of any specific sector, that comes under micro level. Means we are talking about few. Here we are talking about large. This pertains means what? This is related to policies of the bank regarding appraisal standards, regarding loan appraisal, the policies, sanctioning, delivering process, monitoring review. So policies are being formulated for any particular criteria, not for whole of the thing. Collateral security, okay, like we have seen the agricultural finance, what upper cap was, upper cap was 2 crore. It means this has to follow everywhere. It is a macro part. If we say in any particular sector, okay, in any particular bank, the, you can say the interest rate is this much, this amount, so it means it is related to micro levels. The guarantees, corporate guarantees of holding company. So micro means at a small level, macro means at a large and huge level. I hope this much is clear to you. Shall we proceed further? Now, there are few internal and external ratings, okay, by RBI. So, internal means what? Domestic, the CARE, the CRISIL, India Rating, Private Limited, ICRA, Brickwork, SUIT ratings, Informatics, evaluation and rating. So, these comes under the rating, credit rating of India. International, the Fitch, Moody's, Standard and Poor's. So, this is of international important. Here, so credit rating by the RBI domestically, that is internal, and the international means the external. And let me write all the full form of this special so that it will be clear to you. And I upload the PDF after the YouTube session ends. So you all download the PDF and go through it once. Pestle means the political, economic, social. T stands for technological. L stands for legal, and E stands for environmental. Environmental, you can also say ecological. So this is pestle. It consists what? The external factors that are the uncontrollable factors which we cannot control them. Now, one important topic, that is CICS. First, what is the formula of CIC? That is Credit Information Companies. So, what are these companies? What are the role of these companies? So, these companies, they collect data of everything. They collect data of all the individuals. They collect data of different business. They collect internal data as well as the external data, so that a proper, you can say, proper hierarchy has to be maintained, so that you can find the credit worthiness of the borrowers. You can see that they will return your money or not. You will see that lenders are capable to give the borrowers money or not. Everything they will check and they will find out. That is chief information companies. So these are organizations that will collect, that will maintain, analyze what? All the data related to credit, that is credit related data of all the individuals, all the different industries, business. Basically, they will see, they will assess, they will evaluate the borrower's credit worthiness. They will evaluate the lenders, how much lender can offer to its borrowers, how much lender can are is able to pay money to the borrower, and the borrower's credit worthiness, that the borrowers are in a stage that they can repay the money back. Other stakeholders to make informed decisions regarding credit approval. So, credit information companies, basically, they are created, they are made to collect the data related to credit of all individuals. Now, global CICs is Experian, again, Global Credit Reporting Agency. It has its operations in many countries. Equifax, TransUnion. So these are few examples, okay? Not very much relevant for your exam, but just for the knowledge. Now, in India, it is CIBIL, Credit Information Bureau of India Limited. It is a credit rating agency. Equifax, Experian India. So these comes under the India, and these are the global chief information companies. Now, when CI, Chief Information Companies Credit Information Bureau, it was set up by SBI in 2001, January 2001, with which bank? With HDFC Bank. Three other companies, they have been permitted to work as CIC, Credit Information Companies, and presently there are four CICs in India. In the year 2015, RBI has said that all information companies, all credit institutions, they will become the member of CIC. Means all credit institutions will become a part of the credit information companies, and they have to submit all the data to CIC. All the data related to historical, the past data, the present data, all the reports to whom? Chief information companies, so that proper credit rating can be done and there are less chances that any kind of default may occur in our country. So to have a good credit rating, so to have a good CIBIL rate, everything, we have to provide every data. The transparency should be there. That's all for today. So we have done few topics related to credit rating. I hope all this was very short unit. Any doubt, anyone? I hope everything is clear to you. Then let's meet you tomorrow at 9 p.m. for ABM and 8:30 p.m. for paper ABFM on YouTube. So till then, take care, everyone. Goodbye. Keep studying, keep watching, and after the YouTube session ends, I will upload the PDF. So you all can go and download the PDF. You know where the PDFs you can download. I have already told you that you have to join the Oliveboard applications, download the Oliveboard applications, and go on the courses section. And in this courses sections, all the YouTube videos, its PDFs have been uploaded there. So you can download from there. Chalo, let's meet tomorrow. Till then, take care, everyone. Goodbye. Good night.